Hi everyone, welcome to this short video on our SPX Options Visualizer. So we at Traderade are always learning, and we want to use any tool we have to improve our chances of doing better in the market. So Mayhem has been coding and been putting together an interesting set of tools for us to help us in our trading journey. One of them is the Options Visualizer. Being a trader myself and still getting along in the journey, I'd love to understand a little bit more about this. So I asked Mayhem to take some time out in the day and walk us through what this Options Visualizer is, how we can read it, and how we can apply it in our own trading journey. Let's have a quick look at our risk disclosure. So today, we're going to cover all these things. And to someone like me who's still learning, who's still getting along in the trading journey, some of these things are very familiar and some of these things are not so familiar at all. But what I always find helpful is to take a look at each of these things and always keep learning about them. This is why we've created a video. So anytime you have any confusion, you can go back and look at it all over again.
Hey, Aisha. Great to be here and to talk a little bit more about the SPX Options Visualizer. I think it provides a lot of value for folks that want to understand how options may impact the S&P 500 and the broader market, but don't necessarily have all of that right in front of them. And there's no platform that exists quite like this, which is why I ended up building it. I built it actually first for myself, for my own trading. And then I decided, you know what, this is so neat and so helpful that we should make it available to our community and to really anyone out there that wants to plug it into, say, tools like Bookmap or MotiveWave.
That's pretty awesome. But given what we're seeing over here, it can be a little bit daunting and confusing. But the way you've explained it to me in the past, it's not really so. So let's get into it a little bit.
Absolutely. So on screen, we have a number of different data points that are updated throughout regular trading hours in the US session based on the options flow that's happening in the S&P 500 index options. And to give a sense as to why that's important for us as traders, the S&P 500 index options is the largest options complex on Earth by far, with about 1.2 trillion of notional value trading every single day. If we take all the equity futures contracts, all the index futures contracts together, the Dow, the Russell, the NASDAQ, and of course the big one, the S&P 500, and we add all the notional value trading throughout them on a daily basis, it's about 500 billion. So it's 1.2 trillion for just the S&P index in notional value traded every day versus 500 billion for all the equity futures contracts put together. We can see it really is options that have become the market. And so the goal of this tool is to help traders benefit from learning about how that flow might be shaping price action during the trading session.
Wow, that is huge. So what we've been seeing in the last couple of years is that options has become increasingly important. And one reason for that is that we have options expiries every day now, particularly at that level, right? And so this can sort of move the market when we have different options levels. And these options levels are quite important. Correct me if I'm wrong.
Absolutely. In fact, going to what you said, about 50% of that 1.2 trillion in notional that is traded daily is for options that are going to expire that same day. And about 80% is for options that are expiring within a week.
That's quite significant, I would say.
Absolutely. And it's important because when we started to see dynamic shift in the interest rate complex, when rates started to move higher, we saw more and more participants expressing their views in options rather than margined futures trades. So options now are the largest creator of a footprint in the volume profile for S&P 500 futures. And what I mean is when you're trading options, a market maker actually has to hedge that exposure. So if they sell you a call, they're buying S&P futures. If they sell you a put, they're selling S&P futures to hedge their delta exposure. Now, this is where the options visualizer comes into play because the options complex has become the greatest price setting mechanism of the market, understanding how that options flow may impact market makers and how their outsized influence on the S&P 500 futures may impact our trading. This tool puts it all together in one easy to understand set of overlays, whether you're using MotiveWave or Bookmap.
That's excellent. So let's get into some of the charts and what these actually look like. Let's look at the visualizer.
Absolutely. So on screen, we can see a chart of the SPX Options Visualizer as seen through MotiveWave. And this is basically imported via Cloud Notes. So there's a data stream that updates every minute throughout the trading day, and it displays some key information. That key information can help us better shape our view as to where price may be headed and where we may find actionable entries, exits, and areas to manage our risk. It all starts off with the most active strikes, which I've named the hot and warm strikes. So we have the hot call and the hot put. That is the most active call on the entire S&P options chain and the most active put on the entire S&P options chain. Then we have the second most active, which is the warm call and the warm put. Those are the second most active on the chain for each of those strikes. And what I found backtesting and analyzing options flow over time is these tend to be very influential. And an example is if you have the hot call and the warm call exceeding the volume of the hot put and warm put by, say, 40 or 50% or in excess thereof, they tend to become very magnetic, especially that hot call. You see price drawn right towards it, and often it will ping it directly. And that has everything to do with the flows of the options market in SPX influencing the underlying, which in this case is the S&P 500 futures.
So just to be a little bit more clear, now you're showing me a chart on a 5-minute time frame. Can this be applied to multiple time frames?
Absolutely. And it's really all about how you're trying to trade this market. So for day traders, they're looking to get in and out within a series of minutes or hours. With swing traders, they're looking at days to weeks. This has value for a number of different types of traders, even traders that may not be trading the S&P 500 directly, but want to understand how the options flow in the S&P may impact the broader market or some of the individual higher weighted components in the index. So for example, if you're a day trader, you're going to focus more on the hot put, the hot call, the warm put, the warm call, right? Because those are going to be levels that are actionable intraday. If you're a swing trader, you may be more interested in some of the other levels that we display, such as the largest gamma levels, which can act like magnets and also provide some degree of support and resistance. So if you're zooming out to a longer time frame, understanding where these levels are and how they may provide actionable entries, exits, and risk management levels is a pretty important thing to be cognizant of as well.
Okay, so if I understand correctly, when you say hot call and hot put, these are maybe the strongest magnets in the market, regardless of the time frame. And then you have the warm call and the warm put, which act as magnets, but slightly weaker magnets than the hot call and hot put. Do I have that correctly?
Yes, absolutely. And the biggest contextual note to add is that if the hot call and warm call have decisively more flow going to them than the hot put and warm put, then they become prolifically more magnetic, especially in excess of 40% delta between that hot call and warm call versus hot put and warm put. And the opposite is true as well. If the hot put and warm put enjoy 40% or more of excess volume versus the hot call and warm call, they can also become very magnetic on an intraday basis. So these can be incredibly helpful tools for day traders because often is the case, you'll see the flow start to really focus on these areas before the price of the S&P futures gets there.
Very interesting. So this is how we can sort of use it, right? When we're looking at price action, we want to see how close it gets to either of these levels. Now, coming to the largest gamma level for like longer term time frames, so we want to look at that as well as a magnet or a magnetic force, rather.
It can be. So we order our gamma levels in order of the largest amount of gross exposure. And what I mean by that is calls and puts at particular strikes. So we have 5 gamma levels that we display ordinarily. The vol trigger is the largest area of gross gamma exposure under price. And the reason that we display it that way is because if you push below the vol trigger and you build some acceptance, typically you see some continuation of selling and an increase in price volatility in realized terms. Then we have gamma 1 through 4, which are in order of net exposure levels on both put and call added together into gross exposure. So basically, the first gamma level is going to be the largest level of gamma, often next to the vol trigger. If the vol trigger is below price, that can be a magnet. If you're within, let's say, 7 to 8 handles of one of those levels, and it's one of the larger levels, you can get pulled or pushed into that and get a bit stuck there because you have so much options exposure there. It can be a bit of a magnet. And a great example of that recently was SPX 6000. SPX 6000 right now is the largest level of gross gamma exposure on the chain. And we find more often than not, we get pulled right back into it, whether we're trading above it or below it.
Very interesting. So this kind of lines up a lot with regular trading, but it gives you an overlay of options activity, which can actually help solidify those levels on regular trading charts, right?
Absolutely. And it makes it accessible for anyone. There are a lot of very sophisticated options traders, and we're all grateful that they share their knowledge with us and we're able to learn. But there's also many market participants that simply don't have the time to study all of that nuance. And so this puts it all into a graphical format that becomes actionable, where you can learn about the validity and the importance of these levels without necessarily getting a PhD in how options work. You can simply see how the flow is impacting price and how positioning can be actionable levels.
So that's awesome. But Mayhem, I see something else here in green. It's called flip. Can we talk about that a little bit?
Absolutely. So that is the gamma flip level. And the gamma flip level is essentially a demarcation. That means when you're in positive gamma territory, you're more likely that dealers are going to change their hedging flows, and those dynamics start to shift into selling rips and buying dips, which, if you think about that contextually and how that would impact the market, it's going to compress realized volatility, right? If you have a really big buy-in, dealers are going to be selling into that. So it reduces the impact. Just like if you have a really big sell, they're going to be buying that dip. So it kind of pulls price back up. So in positive gamma territory, you can usually infer that the market is going to be somewhat less volatile, but also there's some back testing you can add into that. When I've back tested being in positive gamma territory, you'll find you're more likely to see upside continuation. In negative gamma territory, the opposite is true. Rips are bought, dips are sold, exacerbating the potential for higher realized volatility. And in negative gamma territory, you tend to have more potential for downside continuation. So knowing where you are in terms of that gamma flip level is important, because the further you push up above it, within about 3 or 5%, that impact intensifies. Just like the further you push below it, within about 3 to 5%, that negative impact also intensifies. So if you're a day trader or a swing trader, knowing where we are with respect to that gamma flip level is very important to gauging your expectations and managing your risk. For example, if we're in negative gamma territory, I'm going to be more inclined to look for shorts than longs, and I'm also going to take smaller position size because of the increased potential for realized volatility. If we're in positive gamma territory, I'm going to be more likely to look for longs than shorts, and I'm going to be willing to size up a little bit more because it's less likely we're going to have that exacerbated realized volatility.
So the way I like to remember this, just as a sidebar, is that when we are in negative territory, it's negative, and the market makers usually like to chase the market down. So we're more in chase mode. That doesn't mean that if we don't have a violent reversal upwards, that could also be chased up, right? So it's more like chase mode. And then in positive territory, it's a little bit more orderly, I would like to think, and a little bit more positive. And also, just to add that, going back to some of the first charts that you ever created with the gamma flip, and I was very privileged to have access to those charts about, I want to say, almost 3 years ago now, and I've used that a lot in my trading, the gamma flip levels, and they've always been very, very helpful in trying to understand the broad direction of the markets and what may or may not happen when we're above and below the flip line.
Absolutely. And I love how you put that. In positive territory, it's more positive. It is. In negative territory, it's more negative. You get more of a chase environment. You have a more orderly environment, positive. Those are really helpful notes for folks to take away for the core nuggets of knowledge being shared here.
Okay, so now we come to midpoint. Now, I've got what the hot call and puts are. I've got what the warm calls and puts are. I've got what the flip level is. And now we have something in blue called the midpoint. Let's talk a little bit about this.
Absolutely. So the midpoint is driven programmatically. And basically, it only appears when the flow between the top two calls and the top two puts are within about 20% of each other. So when I was back testing balanced days, and if we look at the market, even in options through auction theory, you'll find that when there's similar levels of demand for downside and upside exposure, that the market tends to be more pinned. And often is the case that it gets pinned close to the midpoint level, especially where there's some convergence, right? So more often than not, you'll see the midpoint converge with things like the point of control and VWAP, which makes it even more actionable. You can see how much volume is transacting at that level. So for us as traders, particularly in day trading, but also important in swing trading, we can look at days where there's a midpoint and say, you know what, this is more of a mean reversion day. This is a day where more likely, even if we get pulled down, if flows stay relatively within balance, we're probably going to go right back up to the midpoint. Just like if we get pulled above it, we might get pulled right back into it, because that's where the center of sort of the average opinion is being expressed. And because volume is relatively balanced, we typically trade around that without a lot of directionality. So I like to think of markets as a three-way auction. Buyers having control sends price higher. Sellers having control sends price lower. Those are supply and demand dynamics. But there's also that third stage of the auction, one of consolidation, where there's not really a lot of decisiveness, where neither side enjoys a tactical advantage. And if you're a day trader and you're trying to figure out, well, am I going to have any edge today? Is there any reason for me to try to trade this as a trend day or otherwise? Seeing that midpoint on screen will tell you, you know what? This is a mean reversion day. So if you're not a mean reversion trader, maybe it's best to do something else with your time. Imagine having that at your disposal. So many folks just stare at their screen all day hoping for an opportunity. But if you see the midpoint there and you know you're a trend trader and you're not a mean reversion trader, you're going to say, you know what? Maybe I'll look at something else. Maybe I'll do something else. Just like if you are a mean reversion trader, you'll say, aha, this is my kind of day. I'm going to take advantage of it. So that's the value of the midpoint, and it is updated minutely throughout the trading session. So you'll know if those dynamics change, you'll be able to say, oh, well, maybe we will see a different type of price action. Maybe we'll break out of this range. Just like if it stays there, you'll say, probably more of a mean reversion consolidation or market imbalance type of day.
To be fair, I find those days some of the most challenging to trade, where you have kind of can we say sideways activity, and then we don't really know which way we're going, because trend days are slightly easier. We know either we're trending up or we're trending down. But it's when the market is consolidating, when there is sideways action, we don't really know which way to go. So this is going to be super, super helpful to sort of determine that this is that kind of a day. And then, because for me, for example, I don't really like trading those kind of days very much, unless I'm having a hot streak. And then I'd like to stay away. So absolutely brilliant, very helpful.
And it's, I think, another thing that adds value, because if you're saying, okay, maybe I want to trade options in single stocks today, and we're looking at like large caps or techs or other things like that. If you know the market's in balance, if it's in this midpoint mode, you're going to say, probably not going to have that much of an edge unless these individual stocks have their own catalysts. But if the market's more in motion, if you see one side that really has an advantage, that will also impact some of the higher weighted components of the S&P and NASDAQ. And so seeing this isn't just for futures traders. It's actually for anyone trading the market, particularly these larger cap, higher weighted components, because you'll know if that's a day where you may have some trending, or you may have some motion that you can take advantage of.
So I remember seeing something called vol trigger in our agenda. What's that about?
Absolutely. So the vol trigger is an area where it's the largest level of gross gamma exposure below spot. Right? So if we're trading S&P, and right now on the chart here, it's showing it in ES terms of 6014.75 and the vol trigger at 5932.20. What that would mean is if we got a pull of over 90 handles lower, and we got some continuation, that we're likely to trigger volatility, hence the name, right? So if we go below the vol trigger, we typically see both a continuation of downside being more likely, but also that price action can become more choppy, less predictable, because you've got a lot of positions that are kind of getting reorganized, right? Because if you think about it, if you have so much positioning in puts and calls at that level, and you go from being above it to below it, obviously that's going to change how market makers hedge. It's also going to change how some of these folks may view their positions, and they may reorganize them. If you're on the wrong side of those calls, you might begin getting out of those. If you're on the right side of those puts, you may begin rotating lower. So it impacts market action, and it's often a sign that we could have some downside continuation.
That makes sense. So thank you for going through all these levels and explaining them so nicely. But we've been talking about the E-mini S&P 500, right? So the ES. And I'm just wondering, for someone who doesn't trade the E-mini or doesn't trade the SPX, how helpful would this be to that kind of a person if they only want to trade, say, single stocks, or they want to trade SPY, they want to trade Qs? Because many of us, let's say retail, smaller traders, don't always trade the larger futures. So how helpful will that be?
I think it's quite helpful, especially if you're trading something like SPY, QQQ, or some of the top 10 weighted stocks in the S&P 500, because what the S&P 500 really is it's the heart and brain of the market. The vast majority of flow goes through the S&P, and it sets the tone for the broader market. So especially for S&P 500 listed stocks, it tends to be quite important. And there's one other area I also wanted to quickly touch on, which is the put wall. So the put wall and the call wall, these are the largest areas of net exposure. So rather than gross or on both sides of the chain like the vol trigger, the put wall and the call wall are about where there's the largest area of, say, put exposure, which on this chart would be 5982.20 in ES terms, and then the call wall is quite a bit higher. Now, why are these important? Because they tend to be meaningful levels of support. So if you get down to the put wall, more often than not, you're going to see a bounce. If you get up to the call wall, more often than not, you're going to see a bit of resistance, especially during regular trading hours where the options and their flows and how participants are changing their positioning may impact price discovery. So both of those are also programmatically updated minutely throughout regular trading hours, so you're able to determine where these key levels exist. And for example, if you were in a trading environment where, say, the hot put was very active, it was much more active than the hot call, and you see this put wall right below, maybe even with convergence of the hot put, you'd say, this is a reasonable downside target because I know there's support here and I know there's interest here. So maybe I'll put my cover a point above that. So if we get down to it and we sort of dance around it and bounce up, I still get out of that trade with a profit and liquidity now to take advantage of that next opportunity. And maybe that ends up being a pop off the put wall, or maybe it's something else entirely.
So as the name suggests, it's basically a wall where price action can go and hit a wall.
Exactly.
Okay. So coming back to some benefits for traders, I know you started to, I think I jumped ahead a little bit, but let's talk a little bit more about, wrapping this all up, how we can use this on a day-to-day basis, even like, okay, I understand how we can use it if we're trading ES or SPX, but how we can use this even when we're not trading ES and SPX.
I would think about it as taking a pulse of the market, getting an idea as to whether we're more likely to have a trend day, getting an idea as to where price may want to go based on the opinions of that oh so influential options market, which once again trades that staggering figure, 1.2 T with a trillion notional every day, just in the SPX. Knowing that and where that flow is going can give us an edge really no matter what we're trading, but particularly those large cap, highly weighted equities in the S&P 500. And it's also sort of like if you think of the ocean, for example, it's like knowing where the tide is. On high tide, you're having the hot call and warm call exceed the hot put and warm put by more than 40%. You know that stocks are likely to gravitate higher, and you know that it's going to be an easier environment to look for an upwardly trending day. Probably going to be less volatile if you're above the gamma flip level, and you'll know that you're getting to resistance when you get closer to that hot call and or call wall. Just the opposite is true if you have a day where you're trending lower, where it's led by put volume, the top two strikes 40% or more excess than the top two call strikes. And you'll get a sense that this could be a day where we have more potential for downside, where stocks could slide, where trading puts instead of calls could be better for options traders and single stocks, ETFs, or the S&P 500, or futures traders. So it helps us as traders, whatever we're trading, to get a sense as to, is this going to be an upwardly trending day or a downwardly trending day? Where might that trend go? And then on mean reversion days, where's that key level where the market may continue to get magnetically drawn to? It also gives us a sense as to where there may be actionable levels if we zoom out into swing time frame. Some of these levels like the call wall, the put wall, the gamma flip, the vol trigger, these are all really important to track whatever our time frame may be. So I think it helps because it's actionable at a glance. You don't have to stay staring at your screen all day to gain value from this. You can simply take a snapshot at like 10:30 a.m. and then look at it several times throughout the day to get a sense as to how flow is taking shape. Now, if you're a more short time frame scalp driven trader, it can help a ton with that. You can watch as the flow develops on a minute by minute basis to see where you might be able to find your edge. Where might this trend day take me? And how can I know where my exit is to manage my risk and reward? And the nice thing about this is it's continuously updated. Unlike other tools out there that might give you options data that shape some of these levels that only update on a daily basis, this updates minutely. So there's really nothing like they're out there that tracks this on such a granular time frame and updates it so it's actionable for traders of all time frames. And it's a simple, easy to understand interface. And in fact, even though we've covered a lot in this video, I also provide a large comprehensive manual, whether you join the Traderade Discord or you buy this on our platform as an add-on for Bookmap or MotiveWave. So I think in a nutshell, it's useful for many types of traders. And in this context, it's something that breaks down and distills the impact of the options flow so we can understand it without necessarily having to get into all these different Greeks and all these different areas of nuance.
Awesome. So now I'm going to ask you the most important question of all. How do people get access to this excellent tool?
Well, first, thank you. And secondly, we have two easy ways that you can get started. The first way that's probably best for folks that are still kind of learning how all this works is to sign up for the Traderade Discord. You can do so at wap.com/Traderade, and you can also learn more about it by visiting traderade.com/Discord.
So on our Discord, this is live under our trading channel, and anyone who sort of clicks on the trading channel will have this pop up, and it's going to be like a video that's just going on. Am I right?
Exactly. So you'll have access to the visualizer through 3 different streams. We have our unfiltered bookmap stream, our filtered stream, and our motive wave stream, which means that you're able to see it in multiple different contexts, and that can really help you gain a benefit from how this might be impacting the price action during the trading session.
And the other benefit to that is also you get access to Mayhem, who's around almost 24/7. He does sleep an hour or two. But other than that, you can probably get him like throughout the day and ask him questions and seek his help in real time if you need to do so, to use this options visualizer. Of course, we do have other features on Traderade as well, including options flows, live bookmap, as Mayhem just talked about. We have trades, we have updates on the market, we have updates on macro, and just general, fun conversations among traders and who's trading what and what's going on. So it's a great place to be if that is what you want to choose to access this options visualizer. Or else you can purchase it for yourself. Mayhem, can you enlighten us?
Absolutely. So when you join the Discord, you get access to the streams. But if you want the data add-on in your software and you have Bookmap or Motive Wave, we're able to support that on most major data providers for Bookmap. So right now we have Bookmap itself. They're a data provider. We have DXFeed and we have Rhythmic. So you can use any of the 3, and we're about to add IQ Feed. And then on Motive Wave, you can use pretty much any data provider as long as the symbols are consistent. So you can have access to this at your fingertips on your software itself if you want to have a more personal experience. You want to be able to zoom in and zoom out and really, use this tool within your own charting platform. And we will be adding this to other charting platforms in the future as well. So we're already in talks with other charting platforms to see if we can add it to them. And the other thing that I'll say is no matter where you are in your journey of looking at the SPX Options Visualizer, we offer help. If you're on the Discord, you can always message me or post something in the questions room. But if you have questions about signing up to Traderade or buying the add-on for your software, you can always email us, help@traderade.com, and we're more than happy to help. We want to make sure that you have a good experience with our tools and our platform, so we're always there to offer best of class customer service.
Excellent. Thank you, Mayhem. That was very informative and very helpful. I know you've put a lot of work into this. Thank you, everyone, for watching our video today. We'd love to have you on with us at Traderade. It would be great for you to join. We have a lot of educational content there, and we have a lot of other tools as well that Mayhem has built, is building, and you can take advantage of that as well. So thank you. Thank you for listening to us today.
And stay tuned, folks, because we're going to be making videos for those other tools that Aisha's mentioned so you can get a better sense as to what value they offer and how to use them. So until next time, we'll catch you all soon. Happy trading out there.